Welcome to The Keys to Your Legacy with your host, Elijah Keys. In each episode, Elijah will have a conversation with other professionals to discuss how their fields relate to trust and estate planning. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, keyslawgroup.com. Now here's the host of The Keys to Your Legacy, Elijah Keys.
Hi, thank you so much for joining us today. This is Keys to Your Legacy, a podcast devoted to talking about estate planning, trusts and estates, and things that are related to it. And I'm really glad that you tuned in today. Today, we have the illustrious Karen Hahn. Karen is a CPA and has had her own practice for many, many years and deals a lot with people of my like, but I'll let her introduce herself. Karen, go ahead and introduce yourself to our audience.
Well, thank you, Elijah. Thank you for having me today.
Sure.
Introductions, you're right. I have been at it a while, about 40 years now. Time really went by. And as you said, I'm a certified public accountant. I'm also a certified valuation analyst. That means I can value businesses for sale. And I also have a master's of tax. So and my practice is same place where you are at in Milpitas. So do a wide range of public accounting type of work, tax returns, businesses, individuals, the normal things that CPAs do. And in addition to that, I've kind of carved out a little niche for myself, which has to do with trust taxation, which is something I've really grown to enjoy over the recent past.
Well, let's start at the basics here. There's a lot of different types of tax preparers. Can you this is episode 4, so our audience is somewhat new. Can you kind of review who can file taxes for someone else?
Just about anybody can actually prepare a tax return. If you can self-prepare your tax return. Professionals that would do it would obviously be a certified public accountant. Another professional is an enrolled agent. An enrolled agent is someone who has taken an examination given by the IRS and kind of authorized by the IRS.
Okay.
There's CTECs. And then there's just other kinds of professionals that have taken some education and gotten some certificates. But really anybody can prepare a tax return. You don't have to have a license. I would say it's probably best to have someone who has had education, has had experience, and is in the business of doing it.
Yeah. Why is that important?
Well, tax law is so incredibly complex. You can work a lifetime and you're never going to know everything there is to know about tax law. So it's not only the tax law, it's also how to apply it to a person's tax return to get you the best result. And also another important thing is to avoid audit. You want your tax returns prepared in a way that it's accurate, it's complete, it's in compliance with tax law, and it's not going to raise awareness to the IRS computers. You don't want to be audited.
Yeah. So one thing that you mentioned here is that you really have a kind of a specialization in trust tax returns. So it sounds to me like you do a lot of returns for trusts. How is that different from an individual's tax return?
Actually, trust taxation and individual taxation, the rules around it are somewhat similar. The two differences are they're different tax forms, obviously. An individual is going to file a Form 1040. If you're in California, it's 540. A trust is going to file a 1041, and California trust is going to be a 541. What is similar is items of things that are taxable: interest, dividends, stock sales, sales of real estate, annuities, IRA retirement types of things. So the rules around the items of income that would be taxable are very, very similar to individual tax law. Your deductions are somewhat different. The number of deductions that are available to you they're not as many as would be available to an individual.
Okay. So what you're saying is that a trust tax return and an individual tax return are similar,
Right.
but a trust has more complication and fewer what you would call deductions, which means that they probably have a higher tax, that they pay more tax than an individual. Is that right?
They actually, in general, a trust tax return, that the taxes will be higher than an individual. And it's not just because of the deductions, though. It's because if I refer to the phrase tax brackets, at the individual level, the tax brackets are very wide, whereas in trust taxation, the tax brackets are very narrow. Like it shoots up to the highest rate at about $12,000 worth of taxable income. So in general, yes, it's significant. It's probably probably the most significant difference between individual and trust taxation are those tax brackets. So I'm always looking for, where do you want to tax that income, inside the trust or at the individual level? It's an important question. The other thing I
Well,
would take note of between individual and trust taxation, just in general, a lot of people will prepare their own tax returns, their
mhm.
individuals. I would highly suggest that a person that needs a trust taxation return done, have it done by a professional.
So when you say a trust, a lot of people have heard the word of a trust, but have heard the word trust, but they don't really know the difference, or maybe they haven't really thought about the difference of a revocable trust created
Right,
by someone to
right,
hold their lifetime assets and an irrevocable trust.
right.
So when you say a trust tax return, what type of trust do you need a separate tax return from an individual?
Well, as you know, Elijah, there are many different kinds of trusts that a person can set up. I think
Mhm.
the most common that might ring a bell to people is the living trust.
Right.
And of course, the reason somebody would create a living trust for themselves is to provide protection for their assets. And also, upon their death, those assets can move fairly easily to the surviving spouse, or on into other beneficiaries. So, and then there's other trusts. There's special needs trust, which are set up for an individual that would have disabilities, and the trustor wants to make sure that there are assets available to create income streams and other things for that person who has a special disability.
Okay.
There's charitable remainder trust. There's just a lot of different types of trust, and they're all designed for special reasons for somebody, an
Mhm.
individual wanting to set up that
So,
thing.
so what you're saying is that there's a lot of different types of trusts. My firm, I counted a couple of months ago, my firm does 21
Yes.
different
Mhm.
types of trusts, and they're split about 50-50 between what's called revocable or living trust
Right.
and irrevocable. So let me distinguish those very briefly. So
Yes.
revocable trust means someone owns things and they set up a trust for themselves, but they can take the things back.
They
It's called
retain power.
it's
Yes.
called revocable. They retain the power to take the things back without paying anything special.
Right.
And there's a second type of trust called irrevocable,
Right.
meaning that it's not easy to take things back unless they buy them. So I could create an irrevocable trust and give a car to the trust, but I could not take the car back out of the trust unless I bought it. And
Right.
so what you're saying then is the revocable trust that someone sets up to hold that a husband or wife set up to hold a house and hold a bank account or hold a brokerage account, that is not the type of trust that you're talking about with a trust tax return. Is that right?
No, no, that's a living trust in general. There can be some exceptions, but in general, if you have a living trust, any income or deductions that might be involved in that trust is going to be reported over on the personal tax return.
Yeah.
Once it becomes irrevocable, and that happens when somebody passes, basically. Now it's the trust becomes its own entity, and the assets and deductions stuff now belong completely to that trust.
Okay. So an irrevocable trust, not a living trust. An
Right.
irrevocable trust requires its own tax return.
Right.
A
Mhm.
living trust does not. Is there
Right.
ever a time that a living trust does require a tax
Not very often. There are some special kinds of what's called grantor trust,
return?
but usually in a grantor trust, that the grantor, the person who has put the assets into the trust, still is retaining some powers and everything over those assets.
Sure.
So 99% of the time, that income in that grantor trust is still going to be taxed over on the individual.
So what's your favorite thing about being a CPA?
That's an interesting question. I think a lot of times when people think about accountants or CPAs, you can just see the look in their eyes. Oh, that's boring, numbers and somebody sitting behind a desk. But I have over the years, I've been in business for myself for 40 years. My favorite part is working with people. And you know what I will say to you is, when you work with a client, you get to know so much about them just by the process of preparing their tax return. I know how many kids they have. I know if they got married. I know if they got divorced. I know if they have medical problems. I can look at their charitable contributions and know how charitable they are. There's just a host of things: elderly parents, illnesses, college, kids that are ready to go off to college, just all kinds of things I get to know about that person on a very intimate level. And I found over the years, a lot of times you're sharing stories with them, things that have happened in their life over the past year that are important, life events and stuff. And that's what I enjoy about it. The joy, the great events that happen to people, and of course the events that happen that are not, death is probably the big one, right? So
Yeah.
yeah.
So
And
it's
that's what
so
I do
it's
most.
it's the people that you enjoy
I love it. I really,
interacting,
yeah.
learning,
I think the
relating.
other thing that goes along with that is a lot of people are afraid of money and they're afraid of financial
Yeah.
decisions. And I think most often that's not understanding the verbiage goes in there, the terms and everything that people use. But then I think the other thing is people are really afraid of making a bad decision, a wrong decision around their money.
Yeah.
And what I see quite often in those situations that they just won't make the decision because they're so afraid they're going to mess it up. So that's another aspect of what I do. I feel like I can help people understand what's the question on the table and then what are your options and help them to understand how they can move forward. So that's another thing that I've done over the years that I feel pretty good about and I enjoy doing.
But it sounds like in your business, there's kind of two different sides to it then. You have the reporting, which is the return, but then you have the
Mhm.
advising. And what it seems
Right,
like is that you love the advising part of it. The return goes along with it. It's numbers, you have to
right,
present it to the IRS, blah, blah, blah.
right,
But
right.
but you love the relationship.
I do. I do. I feel like I have the ability to help people. Yeah.
We had a lot of conversations, a lot of long conversations about
Mhm.
really what makes a business sustainable. And it's
Right.
really just your ability to help people, right? How many people can you help and how can you best provide the assistance?
I running a business, it's another aspect of what I do. It's not just a CPA. I'm also an entrepreneur, and I run a business. And I am of the belief that if you treat people well, your customers, your employees, the janitor who comes in and takes care of your space for you, I'm a firm believer if you take good care of that, it just comes all around. Call it karma or whatever. But I just think it's an important and valuable way to run a business.
Yeah.
Yeah.
Yeah, I'm of the same opinion where if you take care of people, you do your best to provide the best
Yes.
service and the best relationship that you can, that you'll be taken care of in the end. I think
Yes.
that's I
Yeah.
think that's true.
Yeah. Well, and I think as a professional, a trained professional that has taken the time to get education and stuff, I think it's a bit of a duty actually to take your knowledge and your expertise and to try to
Yeah.
help other people with that. Yeah.
Yeah, I think so. So it's kind of
Yeah.
interesting that you shrunk your firm recently. You had a big firm and a big practice, and you shrunk it down. Are you interested in talking about that?
Sure, I can do that. I can what it was like to build it up and then what it was like to, disassemble it basically. Yeah. It's been a process.
Yeah. Well, but I like what you did, which is that if you're willing to talk about this,
Sure. Yeah.
um, I like what you did where you actually took several employees as mentees and wanted to
Mhm.
set them up with their own businesses and created a relationship with them and created a safe space for them. I think that that's a
Mhm.
really, really admirable way to take a business and to scale it back.
It's been really good. I'm a little over a year, just to back up just a little bit. I mean, I came out of college when I was 22, got, passed the CPA exam, worked long enough to get my license, and then I went out on my own and
Mhm.
started my own office and worked all those years to build a pretty thriving business, hired employees. And here I am, 40 years later with five grandchildren and three wonderful daughters and cry, three wonderful daughters and their family and wanting now to do other things in my life. I'm really healthy still and I've just had some other things that I want to do. But so actually it's kind of been a privilege. Three of my employees that have done really, really well had an agreement with them and they're in the process of kind of purchasing their book of business from me. So I'm still here and I'm trying to support them and we support each other. And of course, as you know, you kind of came into my life also and took over that front office. And it's been a unique way of kind of exiting out of a business, I think, but it's working out really well. And as time's going on, I'm able to work less and less now, and that just feels really good. So it's been a great way of doing this. Yeah.
I'm really glad. I'm
Yeah.
glad you found a good exit. That's a thing to listen to
Yeah.
all business owners. There's a lot of baby boomers out there who have an ongoing business, and a lot of them are just going to be shuttered. right? They have no one to transfer it to. But if you have a business and if you have employees who are really high skilled, I mean,
Yeah. Yeah.
it's not like you took people who were just there for a paycheck. You actually took
Right.
people who were committed, right?
Yes.
Committed
Right.
individuals,
Right. Right.
professionals. You have
Yes.
professionals working for you. You can certainly transition the business to them if you have some sort of agreement, right?
Right. Right. It has worked out really well for them and for me. So
Yeah, that's
yeah.
really good.
And the other thing I might say is it's also been a pretty easy transition for my clients.
Okay.
So just I went from about 1,000 clients to probably me personally, I probably have about 100 to 120 now. But I did
Wow.
what was really nice with the clients is they were already working with these other three people. So for them, the transition was like nothing.
Yeah.
They had already emails, phone calls, all the stuff, and I've still been available to people. So I didn't, drop the clients off the edge of the earth either. So that's
Right.
worked out really well for them. Yeah.
Right. I'm glad that you were able to do that. I mean, it's almost like you had a business and you trained and brought up successors and taught them
Mhm.
to run a business the way you wanted it to be run.
Right, right.
Big problem that a lot of business owners that I see, at least in my practice, is that when they're ready to transition something, they don't know who to transition it to, and they're afraid that when they transition it, that their customers are not going to receive the same type of service that they
Sure.
received before.
Yeah, that's obviously in any kind of a business sale agreement, that one of the things the buyer is very, very interested in is he gonna be able to retain those clients?
Yeah, yeah.
The other thing is since you're kind of getting off into this, I said earlier, I'm a certified valuation analyst.
Okay, tell us
Um,
about that.
so it's a license where you can value business. It's a whole nother niche and specialty and expertise on how do you take, basically you're taking a lot of the financial statements and there's a lot of other things that you're considering and then come and say, what is this business worth? There's a variety of reasons why somebody would have a valuation done. One of them obviously is buy sell. And so one thing I will tell you, and I'm talking about small business persons. I mean, obviously, I don't work with very large businesses just because, it's the size my firm was. But one thing I've noticed about people, business people who may be coming up to that time where they would like to exit is you really need to start that process 5, 6, even 7 years before you're ready to do it. If you're going to get a good price and just the other things that you want to do, transition your employee, transition your customers, just make it a good deal for everybody. It's not something you do over the course of a year, very frankly. It really is something that needs to start 6 or 7 years before you're ready to exit. And I think for the most part, small business people don't do that. They're too busy. They're running their place, doing what they do. And now you want me to add one more thing on. But for anybody out there who's running their own business, you really need to start that process very, very early on if you're going to make a good transition.
Yeah, you said you have to start at 5, 6, 7 years before.
Mhm.
Why is that? What are the features of a business sale that are different from someone just transferring it in a year or two?
Yes. So the top indicator of what a business worth is its cash flow.
Okay.
An analogy perhaps is, let's say you have $100,000 that you want to invest somewhere.
Mhm.
And so you look around, where can I invest this to get a good interest rate? I can get a certificate of deposit. I could put it in mutual funds. I could buy some bonds and just a host of other things where you could get a particular interest rate, right? And so what's that 100,000 going to do? It's going to generate interest or dividends, right? So it's going to grow. So buying a business, it's the same concept, really. Let's say you have $1 million and you want to buy a business. Why are you buying that business? You want to buy the business so it will make money.
Mhm.
So it's the same idea. So when a potential buyer is looking at a business, what they're looking at is what's the cash flow from the business.
Right.
So in order to do that, you need to have 5, 6 years of really growing good profits that are generating cash.
Okay.
So let's say you haven't had that so much and next year you want to sell your business. Well, the buyer doesn't have a lot to look at. So the reason you need to start early is you have to generate cash from your business and you have to grow those sales and those profits.
I see. So if you're looking at a small business, right, and the owner's really just trying to feed employees and themselves, what you're saying is that in order for the business to sell well, it has to be economically healthy. Is that what you're saying?
Yes. So a key phrase that I like to use in terms of a business owner is, do you own a job or do you own a business?
Yeah.
And there's nothing wrong with owning a job. So
Sure.
like if you have a particular specialty and you have a client base and it's you and maybe you have a couple of assistants, you own a job is
Yep.
what you do. And you're making good money, you're getting benefits, you got your medical insurance, you can take your vacations and all that stuff, but you own a job. And so a potential buyer is going to go, okay, well, if you leave, are the clients going to stay with me? So in that particular scenario, you own a job, you don't own a business.
Yeah.
What you want to do is you want to present facts and information and stuff that indicates you own a business. Hopefully
Right.
that makes sense what I just said.
Well, so let's distinguish that because there's a
Yeah.
book, a bunch of books on that. One of them is called
Yes.
The E-Myth, which is probably
Yes.
the most
E-Myth
popular
is
one.
great. It's a great book. Yeah.
Right, by Gerber, I think. He talks
Yeah.
about the stages of a business. He talks about the infancy of a business, which is a
Mhm.
person sitting alone in a room by themselves. If they do
Mhm.
not work, no business moves forward.
Exactly.
And then you have the adolescence of a business. I think he talks about 3 stages. So some other books will talk about 4, but 3 stages that he talks about,
Mhm.
adolescence,
Right.
where it's the business owner who still works in the business.
Right.
And if that business owner stops, the business will continue for a period of time as it continues working through the workflow that's going on. But if the business owner stops working permanently, the business will stop as well because they're
Right.
an integral part of it. And then I think it talks about maturity, which is where if the business owner isn't there, the work continues regardless.
Right.
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 So the way that I look at that is I look at that as I run a business, but I do all the sales meetings. So if I stop, the business will continue as long as we have clients
Right.
working. But if we need new clients, I have to be there. So my business is in its adolescence. So if you're telling me, what
Right.
you're telling me is that my sale value of my business is the revenue that it produces, the profit minus my cost. So someone to replace me in my chair.
Yes, and part of valuation theory is that you're going to, whatever the salary that the owner is pulling, that is for his services.
Right.
Give you a quick, let's say that person's making $150,000, and that's what you would normally pay an attorney or a CPA, whatever, for what they do. So in valuation theory, that is going to be factored into it because now the buyer has to replace that. But let's
Right.
say that expert is making $250,000.
Okay.
Now they're $100,000 above what the market. Well, what you have is $100,000 worth of cash flow there. Does
Right.
that make sense? Yeah. A famous example, I believe it's in the E-Myth books, has to do with McDonald's, the McDonald's story.
Yeah, the
Um,
franchise, right?
I can't remember the names. It was a Ray Kroc. Was that his name? I believe
Yeah.
was. And so what he did is he very precisely created that wonderful hamburger. Some of you may not like McDonald's, but he measured everything and everything was incredibly precise. The bun, the pickles, the ketchup, everything. It was completely measured. And then he wrote up complete instructions on how you produce that hamburger.
Right.
Right. So now what happens? He can step away. And as long as you follow his recipe, his exact directions, you will be able to replicate the results that he had. So that's kind of the idea or the theory on, do you own a business, is can you do those kinds of processes? Can you create processes and procedures in your business across all levels of it, where if this is just followed, this is the result you're going to get.
Yeah.
That's the theory behind that. And that's going to be a business that's going to be hired a lot more
Right.
valuable than a business that has not taken the time to do that kind
Well,
of stuff.
it's repeatable processes.
Exactly. And it's
Um,
not just professionals like you and I, it's
Right.
factories all over. And even Ford was the one who kind of set up that whole process.
Right.
So yeah, that's just kind of the theory behind it. So a business that has that stuff in place is going to be worth more than a business who does not.
It's really interesting.
Yeah.
Yeah.
Oh, yeah. Maybe an interesting thing is, do you know valuation theory, where it started?
I don't. Tell me.
Okay, fascinating. It started during Prohibition. Because,
With why during Prohibition? I'm not seeing
well,
it.
because I forget which amendment it was, but it was passed that alcohol was no longer legal in the United States.
The 19th Amendment.
Was it the 19th? Okay. And what did
That's
that
okay.
do is that law, the government completely shut down a complete industry, right?
Mhm.
And so what the government did is they reimbursed these companies for the losses that they were going to incur. So a huge part of valuation theory, processes, procedure, all of that comes out of prohibition. And actually the IRS has had a major part to play in the creation of valuation theory. So I always thought that was kind of interesting.
I
That's seemed to be.
I should go back and amend my statement. I don't know if the 19th Amendment stopped it or restarted
Yes,
it, because it
I
was
don't.
stopped and then
Yeah.
restarted. I don't know which one it was,
Yeah. I
but
don't remember either, but yeah, that's how
that's
yeah.
that's interesting from a lawyer's perspective.
Yeah.
That's very interesting because there's a phrase, a clause in the Constitution that prevents the government from interfering with someone's business or
Mhm.
someone's relationships, right? It's called the Contracts Clause.
Okay.
And so it's interesting that basically that was viewed as a taking, where if you shut down an entire industry,
Right.
just shut it down, which is what that amendment did, that the government was basically stopping people from actually doing a valid business. And therefore, the IRS had to pay them out for the value of their business because they were basically taking it away.
Yes.
So
That's
that's interesting.
yeah, I always thought that was an interesting little tidbit.
I didn't know about that.
Yeah, there you go.
Yeah.
Something to share at your next party.
Yeah, let me tell you, we're full, my firm, we're full of stories. And
Yeah.
I don't tell client stories likely. I don't go around telling clients,
Yeah.
but just situations which are just kind of ridiculous with
Right.
certain families when they fight. Yeah, we
Yes,
fight.
I getting back over to the trust, and maybe it's just because it's the population of people that are coming to me, but it's kind of sad. I would say 8 out of 10 families just they fall apart when they start fighting over, mom or dad are gone, and somebody's been named the trustee in the family, and the other siblings don't like that, and it's really sad how many families just absolutely fall apart. Um,
I have two observations about that, and I
yeah,
see it all the time.
yeah.
I think my first observation, and I don't have enough data to actually come up with a valid theory,
Right.
just by observing. The first thing that I see is that siblings who get along, they get along without their parents' intervention. So a brother and a sister, if their relationship was always moderated by mom and dad, they
Mhm.
can't actually talk together in a room without mom and dad without fighting. Those
Yeah,
people are going to fight more because mom and dad will no longer be able to chase them down and say, well, you did something wrong and you did something wrong. No one is going to police their relationship anymore. So
right,
basically, number one, it's a maturity issue
right.
where these individuals who are fighting all the time, they actually, their relationship, now, not saying that they're immature as individuals, but
Yeah,
their relationship never matured past the teenage I hate you and you hate me stage,
right, right.
right? They're still teenagers in their relationship together. And I think the second thing is economic maturity, that's a lot of people who fight, not all of them, but a lot of them don't have a clear understanding of what it means to actually correctly manage money
Yeah,
because
yeah.
they hire attorneys. Let me give you an example. We had a trust an administration of a trust. Someone passes away, and so you have to follow the rules of the trust. So we administer the trust contract, and we had offered a family of four kids, to help them administer this trust for a certain percentage of the assets, which is how we work. And in the end, two of the siblings decided not to hire us and hired another attorney. And the two siblings that we represented hired us, and it ended up costing 7 times the cost.
Yeah, yeah,
7x. So who won the most? The lawyers won the most. I got 3.5 times what I originally offered, just
right,
because now we had to fight and fight and fight and fight because the other siblings didn't understand the value of what they were actually receiving.
right,
They just
right.
wanted to win a personal argument.
Right, I've seen that.
So,
I had this has been a long time ago. It was a man who had taken care of his mother while she was still alive. She had a sister, and mom died, and the estate wasn't huge, but there was some money there. I mean, and the sister just took all kinds of issue with the brother. And so we had to do a court accounting, which is a formalized, it's still debits and credits, but it's a formalized format for the accounting that has to be presented to the court.
yeah.
And so the sister forced a 10-year accounting, and it was, I'm trying to remember it. I think it ran around $30,000 to $40,000 for the accounting fees. I'm not even talking about whatever the attorneys got. And in the end, she was squabbling because the brother couldn't document getting the grass mowed, or had some some receipts to Walgreens that he couldn't figure out what they were. And it wound up really being small stuff. And it was just kind of sad because in the end, she got less money. Right. And really, we weren't able to find where he had been stealing money or and mismanaging or anything.
But
Yeah.
it's the point that she got to win, right? So she won the small argument of not tracking how much you paid the gardener to mow the grass,
Right.
and not tracking what you bought at Walgreens, whatever it
Right.
was, right? Maybe we
Right.
bought adult diapers, maybe we bought formula for our kids, right? Who knows?
Yeah.
And she got to track that, and she got maybe a correct understanding that her brother wasn't stealing, but it cost her $30,000 to do it.
Well, it also cost her brother. I mean,
Yeah,
the relationship was over.
yeah.
What they had at that point was each other in terms of relatives.
Yeah.
Because at least my client didn't have children or anything. I mean, so it wasn't just the money; it cost her family.
Yeah, it's the supposed bad suspicion of theft, and the only thing that I caution people against when they're demanding that information
Yeah.
is, remember, mom and dad are not here to fix your relationship.
Right.
Is the money worth it? Let's pretend that everything that you think is correct and that someone actually has stolen $2,000 out of a $3 million estate.
Yeah.
Do you want to enforce that? Do you need to be right? Because if you do, you're going to attack your sibling, and your relationship might literally be over. You might be right, you might be wrong,
Yeah.
right? Unless this is hundreds of thousands of dollars, it might not be worth your relationship because you're going to lose it.
Right. Well, I've had other situations. One I can think of is two sisters, two brothers, and they took sides, sister brother and sister brother. And when it was all over with, they no longer had relationships with each other.
Sure.
Yeah.
Yeah.
And it wasn't what I would call significant sums of money either. I'm not sure that should ever be the main point, but it was just kind of sad, you know.
There are some people that the only thing that they'll listen to is actual threats, and that generally comes back to the parents not teaching them personal responsibility. Happens a lot with young adults. I don't want to make any judgments or aspersions against other people.
Right.
That I tend to see the worst of the worst. Right.
Yes. Yeah. I think,
And,
yeah. That's what I
and
was saying. The population that comes to me are the ones that are having issues.
yeah.
So I probably don't get to see the families that are doing well and they're just helping each other to get through a hard time. And so I probably don't see a lot of that. But yeah.
I get kind of an even mix,
Yeah.
mix of people who are doing well and people who aren't.
Right.
But also the people who are doing really well who say, hey, let's skip the lawyer and just do this ourselves. I don't get to see that. So I don't see the families that are really, really, really healthy. I only see the families that are partially unhealthy and super unhealthy.
Yeah.
So
Yeah.
my predictions are skewed.
Right.
Sure.
Well, and the other thing I never get to see, obviously, because they've passed, is I don't get to see mom and dad. So
Yeah.
I don't know what that dynamic was. Did they have
Right.
favorite children or, which brings us back. I don't know if something you're going to talk about is how do you prepare a trust document so that your children will survive your trust document?
Well, the answer to that is that it's not about the trust. The trust is just a tool.
Yeah.
And just like someone can misuse a gun, a knife,
Yes.
a nail gun,
Sure.
a hammer, someone can misuse a trust as well. And you can use it for good things and you can use it for bad
Right.
things.
Right.
And it comes back to a book that I read a while ago called Complete Family Wealth,
Mhm.
that talked about the relationship between people who kept their inheritances, people who didn't.
Right.
And it defined generations, not individuals, but it defined generations, that if you have a generation that earned significant wealth, the book called them a G1. Generation one, the person who earned significant wealth. And you're not talking Elon Musk or Jeff Bezos. You're talking someone who earned much more than their peers would have earned.
Right.
And then you have generation two being the generation following generation one. They didn't learn the habits that were needed to earn that money,
Right.
but they learned how to spend it and how to maintain it. They didn't learn how to earn it.
Okay.
So G2 maintains it, and G3 doesn't learn how to earn it and doesn't learn how to maintain it. They only learn how to spend it. So
Right.
oftentimes after 4 generations, the entire estate is gone. You can see that with the Vanderbilts. Vanderbilt's 5 generations ago, they were worth billions, and now they're worth just over $1 million, right?
Mm.
So it really has to do with training the next generation, training them for emotional maturity as well as economic maturity. You can see that with the Rothschild family,
Right.
who has expanded their wealth after many generations. And it really has to do with the fact that before anyone can touch that money, they have to have some background in finance and
Right.
understanding of how it works. And so it's not about the money. It's not about the trust. It's always about the character and knowledge of the individual. So if I could, I leave this advice very often with my clients,
Right.
which is that you can give anybody as much money as they want, but you can never give them economic security unless you teach them how to use it.
Right. Yeah,
Money,
I couldn't agree with you more.
money
Just
is
a
just
little,
a tool. It's just
yeah,
a thing.
yeah. A little sidebar, real quick. When my kids were teenagers, the way they would get their allowance, everybody's gonna laugh at me. It's the accountant in me. The way they got their allowance is they would bring me a balanced checkbook. Yes,
You get your allowance if you have a balanced checkbook.
that's right.
Well, we have
That's how they got their allowance, and it wasn't like if you can't get it to balance, I will help you. I mean, it wasn't that bad, but they didn't get their allowance until they brought me and that's back in the day, check register and stuff.
Yeah.
But I would have to say it taught them some things. It made them look at their money on a regular basis, kind of forced them to look what they were spending it on.
Right.
And that's the way they earned it, is by taking good care of it. So
Right. They're good stewards. Well,
yeah.
I really appreciate you coming on here.
Yeah, this has been fun. Thank you.
Go tell the audience how they might be able to contact you in the future if they're interested in talking to you about a trust tax return.
Okay, so you've got my name, Karen Hahn, and I can give you my telephone number. It's 408-263-8888, and I'm in Milpitas. My email address is karen@khancpa.com.
Great.
Yeah.
Karen, it's really nice to see you today.
Yeah, thank you.
Um,
This has been fun.
Good. To everyone who's listening, thank you so much for tuning in to Keys to Your Legacy. Go ahead and like and subscribe our videos. We'd like to ask you to leave some comments and either on Spotify, Apple Podcasts, or whatever you view podcasts to let us know what are the subjects you'd like us to cover. And make sure that you subscribe so that you can keep getting information about creating the Keys to Your Legacy. Thank you so much, and we'll talk to you next time.
Thank you.
Thanks.
Thanks.
You've been tuning into The Keys to Your Legacy with your host, Elijah Keys. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, keyslawgroup.com. Thank you for your positive reviews, comments, questions, and for sharing this show with others.